Ugh, bonds. Am I right? They are my least favorite thing to talk about. In the last 10-ish years, the US aggregate bond index has returned, wait for it, a whopping 1.47% annually. They are so boring. They are kind of like the vegetable on your dinner plate, a necessary ingredient for a balanced meal, but not anything you want to write home about. In fact, when asked about bonds in the context of a portfolio, I describe them as a stabilizer, a hedge against your equities volatility. You could maybe eke out some more return by buying lower quality bonds and assuming more credit risk, but is it really worth the reward? And to make matters worse, the boring became just flat out ugly the last 3 years. The Ag Bond Index had a negative 2.5% annual return for the last 3 years. To add insult to injury, the economy as a whole, with its high inflation and high interest rates, has actually increased the correlation between stocks and bonds. We saw it for real in 2022 when both stocks and bonds had a record bad year. This higher correlation means that these boring, underperforming bonds aren't even stabilizing anymore. Is it time to rethink our bond strategy? Yes, it is. But don't throw the baby out with the bathwater just yet. First things first, let's talk about bond alternatives. Everyone is asking about money market funds these days. Most of them are paying around 5%, with several paying more than that. For clients with short-term goals who will conceivably need the money soon, yeah, the higher rate and liquidity in a money market fund is hard to beat. But we know that's not a long-term solution. Historically, even short-term bond funds have outperformed a money market over time. We could look at other hedges against equities. Options are an example. Unfortunately, they are complicated and not readily available in a 401k. The same goes for alternative investments, annuities, and cryptocurrency. Many 401k plans do offer a real estate fund, but that's not exactly a basket I want to put more of my eggs in right now. So we're back to bonds. And as much as I loathe them, it may not be a bad thing. At some point, the Fed will start cutting interest rates. When that happens, the Treasury yields should drop and bond prices should start to rise. Vanguard themselves declared bonds are back in their 2024 outlook, not just because of a more favorable interest rate environment, but because they believe equities are overvalued. That very sentiment has been echoed by analysts with Bank of America, Goldman Sachs, and JP Morgan Chase. And this is exactly why we stay the course, because it's at the very moment when you just want to totally give up on an asset class that it's poised to make a rebound. That's it for this week. This is Jeannie, the 401k lady.